Hello everyone, welcome to today's Merk webinar. Our topic is on the U.S. elections. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk. Joining alongside Axel will be Senior Financial Analyst Nick Reese and myself, Financial Analyst David Song. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation by typing it into the questions box on your screen. Please also note that this presentation will be recorded. And before we begin, as an announcement, we will be having our quarterly webinar on October 18th, just next month. So mark that down on your calendars, and we will also follow up with reminder emails. And with that, I will now turn the call over to Axel to begin the presentation. Axel, the floor is now yours.
Thank you and welcome everybody. And let me start out by showing you those two pretty pages here. What's interesting about this webinar may be that most of the time, while I don't always have a positive outlook of the market, I'm not trying to offend my audience. That said, in today's webinar, I am going to try to play the role of an equal opportunity offender. To put it up front here, I don't like either of these candidates, and the role I have here is not to try to convince you of whether one candidate is better than the other one, but the role I see myself in as a portfolio manager, as an analyst, is to think about the sort of things that might happen when one or the other gets elected, and most notably zooming in on the sort of risks that might be underpriced in the markets. And the sort of things that an investor can do to get ready for what may be ahead. Obviously, if we think the market is just going to do what they always have been doing and go up and up and up, and I say that obviously in quotes, they of course haven't always gone up, but that certainly feels like that. And of late, then there's nothing to worry about, nothing to think about. That said, I do think there's plenty to think about and to worry about, and indeed, if anybody manages money on somebody else's behalf, I do think it's anyone's fiduciary duty to think about these sort of scenarios, and any individual investor, of course, for themselves might want to take these things into the consideration as they look at the portfolio, review their portfolio. So what I'll do is I'll give a big picture overview of where we are in the market, talk a little bit about the most recent action at the Fed, then we'll dive into the election itself, looking at some odds you might not be considering and the context you might not be considering. And then we talk more specifically about the impact, and then finally on certain areas of the economy, on the markets, and then we'll dive a little bit deeper into certain details as well. Anyway, I've shown you a similar page as the one you see here before, and the reason I show that is that, and obviously I've moved here away from our local candidates. Of course, I show one in the middle, but the one I show in the middle is specifically one who's not running. I'm showing those sort of things, everything from the Brexit thing to the Greek issues to various other things, and including a picture of Mr. Abe and Mr. Putin, to show you that the U.S. election, as captivated or as engaged we are in it, it's really part of a global trend. And the global trend I'm referring to is that we are in an environment where I believe populist leaders, or at least candidates, are on the rise, where ultimately political stability is on the decline. And in the U.S., we have more robust institutions than many other countries, or most other countries have. And so in the U.S., it might have less of an impact, but we shouldn't kid ourselves. The sort of things that are happening in the world, they are all interrelated. And without going into all the details, the short of it is that a lot of people have had their real wages stagnate or decline. In the Middle East, people couldn't afford to feed themselves anymore because of rising food and energy prices. And so they started revolution, not because they loved democracy so much, but because they were young and hungry, and so they decided to change something. I put Mr. Abe in Japan in the same camp as a populist leader. Mr. Putin certainly as well. The drive to pursue the Brexit is a populist movement. And what populist movements have in common is that they have simple answers to complex questions. And those simple answers do tend to have a bunch of ripple effects that affect investment portfolios, most notably. The other thing that populist leaders tend to have in common is, and not just populist leaders, leaders in general, they rarely ever blame themselves. They blame others. The political opponent for traditional leaders, populist leaders tend to blame a minority, for example, or foreigners. And that sort of attitude can be rather destructive. And I'd like to refer to the 1930s, and that didn't end very well. And I'm not suggesting that any particular candidate running in the U.S. or any particular politician in office abroad right now would take us down the same road. But I would like to caution that the sort of pieces we have around the world are not very encouraging when it comes to political stability and the trend we're moving on. Now, I show you another chart here, or abstraction of a chart that I've shown in the past, and to just kind of put a context of the environment that we are in. And Nick in a minute here is going to talk more specifically about volatility, but in our analysis, in the quote unquote normal world, if such a thing exists, you have forces that support a traditional portfolio construction, meaning you have a market-based investment portfolio investing in stocks and bonds. And the reason you do that is because your risk-adjusted returns might be optimized through a market-based portfolio. And the reason is that you have such diversification that one thing goes up, another thing goes down, and over time, by having your eggs spread a little bit to stocks and bonds, and within that, having a kind of a market-based portfolio, everything is dandy. Well, you can get distortions in a portfolio, and those distortions can come along when volatility is on the rise, or when complacency is on the rise. And we got this error here to correlation moving higher. It's really a kind of it's really fragility that we're measuring. And what we do internally is how many factors do we need to explain what's happening in the market? Meaning, is it just one lever that drives everything in the market, or is there great dispersion? Are lots of different things driving things in the market? And so when we have a calm environment, low volatility, but everything is quote unquote moving in tandem, we're complacent. And then what can happen is, well, if volatility comes back, we move to a scared environment. And a scared environment is kind of the panic mode where everything is moving in tandem, but it's moving at breathtaking pace. And the challenge with complacency is that, in our view, that's kind of the environment where you can jump into scared very easily. Complacent environment is one where people get overconfident because nothing can possibly go wrong. Look at how low volatility is. Look at how asset prices are moving up. And so that's a kind of to put that into perspective. And let me pass it here to Nick to talk about here a chart that we don't talk too much about, and I'll probably chime in the end. But I want to talk to you very specifically about something in some ways extraordinary that's happening in the markets right now. Go ahead, Nick.
Thanks, Axel. Well, to explain what we're looking at here, this is what we refer to as the CFTC positioning of speculators in this particular futures market, and these are VIX futures. Many of you are probably familiar with the VIX index. It essentially measures the 30-day implied volatility of the S&P 500, and these futures contracts are priced. The P&Ls are priced based off of where that reference index is. And the chart here shows the net positioning of just the speculators, so basically the profit-seeking market participants. And so this line being deep in the negative territory shows that on net, if you combine all the positions that the speculators are running currently in this market, they're actually recently running basically a net negative 120,000 contract short position. They're selling VIX futures. And because of the shape of the forward curve of this market being upward sloping, selling these selling these futures contracts is actually a high yielding position. You get a positive roll yield. If any of you have invested in the ETF VXX, you don't have to have the VIX index change at all for that index to lose value, and that's because that's a long volatility position. And what they're doing underneath that ETF is they're buying and rolling these VIX futures, and they're capturing a negative roll yield as they do that. And so if you're on the opposite side selling VIX futures, you're actually picking up that roll yield. And as we're in a world where that is starved for yield, where interest rates are so low in many of the government bond markets around the world, including in Japan and the Eurozone, this is essentially a yield proxy position, or a synthetic kind of risk-on long stock position. And recently, you can see there's a little bit of an uptick in the last reading, but basically this has been at extreme bearish positioning from the speculators. Axel?
Yeah, so let me try to translate that to plain English, and I certainly don't want to confuse it too much, but I want to explain a little bit why we think this is important as well. So just let's take a step back. You've all heard that people are chasing yield. They go after high-yielding dividend stocks, they buy junk bonds and so forth, and overall people then are scared that something might go wrong, and so you might want to buy protection. And one way to buy protection is that you're buying volatility. Well, as Nick has pointed out, buying volatility is extremely expensive. You lose about 10% a month or so if you do that. Well, guess what? Somebody is on the other side of this trade, and this is the other side of the trade. And by the way, this is not investment advice. We don't encourage you to do this. But there are people that are kind of selling volatility, and what that means is that they are kind of gobbling up the positive carry, gobbling up here the opportunity that the volatility is not going to blow up. And the idea here is that that in itself distorts volatility in the market. So we've all seen that that volatility is low. Well, now you have speculators betting on volatility remaining low, and they're betting on that to extreme, and that in itself is creating market distortions. And so the question then becomes, how can we trust the sort of things that are in the market, and how is that going to unwind? Usually when you have a lot of yield chasers, at some point that can have a violent backlash. And so this is just one source where, if we want to put it into real plain English, we have a kind of a pressure cooker of low yield where we're masking the riskiness of the market. And because of the dynamics in the market, all of that is amplified with people betting on volatility itself. And that in itself, that market has driven to extremes. So I wanted to get that in there because I do think that it's part of the puzzle as to why volatility is so low in the market. And that sort of trade works, by the way, until it doesn't. And the folks who pursue it saying, if it goes up to volatility, never mind, we'll net, and at the end of the day, we'll still make money. Again, we don't recommend that anybody does that. So let me give you another here big picture item, and while we're here, where are we with the Fed and so forth? The Fed again didn't move, didn't hike interest rates. Fed was asked if are they political. Janet Yellen said no. Our experience, when you ask somebody who is on the FOMC, they always say no. If you ask somebody who's left the FOMC, they say, well, we don't want to be, but you can't really ignore it. And so these are this is where we are on what the market is pricing in as long-term inflation expectations going forward. And what we see is that we don't make progress as far as the central banks consider progress. This is the Fed and the ECB. They really would love to have these charts a little bit higher. That said, Mr. Draghi, the head of the ECB, the other day said that, never mind, these market-based measures aren't all that important. He used to think these are very important, giving us a sense that Mr. Draghi is stepping a little bit away from focusing on inflation. And for Janet Yellen, this is kind of becoming more relevant because it is she is looking for excuses not to hike rates in our assessment anyway. And she says that, yep, unemployment is low, but look, there is no inflation. And in our view, she wants to be firmly behind the The yield curve, she is going to raise rates at some point if the economy continues to improve. But guess what? If she doesn't hike rates in December, which is currently what the market expects, then she will have raised rates once in 12 months and by 25 basis points, 0.25%. If you think that inflation has gone up more than 25 basis points during that period, then actually we've had an easing over the last 12 months. That's something people are sometimes forgetting to think about. Now, that said, we talk about these low rates, but there is something hiding in plain sight that I also like to make everybody aware of. And I pass it back here to Nick to explain something. And sorry, Nick, I always give you this complicated stuff to explain, but go ahead and give it a shot.
So many of you may have heard that LIBOR rates have been rising recently, and that it is at least in part related to changes, some fairly kind of esoteric changes that are taking place in the U.S. money market rules. And this is a kind of a result of Dodd-Frank that's had a long lag time. This rule change has been known about for about 4 years now, and it's coming into effect October 14th. So we're really coming up on it. But basically, what it means is
you want to just explain briefly what LIBOR is for those who get confused?
Yes, certainly. So LIBOR, the LIBOR rate is the London interbank offered rate, and it's basically it's quoted for a number of different currencies, but here we're talking about U.S. dollar LIBOR. And it's basically the interest rate that banks outside of the U.S. can borrow and lend U.S. dollars from each other. And the way that one of the ways that those banks get their dollar funding is from U.S. money markets. And the riskier money markets, which are known as prime funds, really the bulk of what they invest in, if you look at the numbers, is overseas bank commercial paper. So they will provide U.S. dollar funding to these overseas banks and make a higher yield on it than they would on other types of money market securities such as U.S. T-bills. But given the changes that are taking place, there's going to be a distinction. Not all money markets are going to be under the same rules, which were fixed NAV. In other words, the money market could not, quote unquote, break the buck. You would always have, it's essentially like a savings account with a little bit more yield. Well, now in the prime funds, there's going to be a floating NAV, so you could actually get it, redeem your shares for less than par, less than $1. And there's some other restrictions as well. There could be, under times of stress, a 10-day lockup period where you couldn't get your money out. And so, as a result of these changes that are going to take effect in October, a number of prime fund investors are pulling money out of prime funds and putting them into government-only money market funds where the rules are still the way that they used to be, where the buck holds. And those are primarily U.S. T-bill investments in those money markets. And so you can see here on this chart, the blue line is LIBOR, and that's actually starting to move up. And you see here recently the 3-month U.S. T-bill rate in red starting to move down as there is this rotation from money market funds investing in overseas bank commercial paper versus U.S. Treasury bills. And what it means is that these overseas banks are having a harder time finding U.S. dollar funding for their balance sheets. Let me pause there and let Axel fill in the missing pieces.
Sure. So why the heck do we show you this when we talk about an election? And the reason is because I think this chart is incredibly important as far as what's going to happen to the markets we think about, especially to the dollar, to the dollar's reserve currency, all kinds of things. And I'll publish a newsletter on it in briefly. But a couple of things. First of all, it means that even if the Fed hasn't hiked rates, we have a tightening of financial conditions. And Nick just focused on foreign banks. To just give you the scale of this, in 2011, we wrote a newsletter at the time about it. Half of the holdings in U.S. money market funds was in commercial paper, denominated in U.S. dollars, but issued by European banks. And you might recall, European banks weren't exactly the most creditworthy counterparties at the time. One of the major brokerage firms had 75% of its holdings in that sort of commercial paper, and that market is drying up now. Now it's not just European banks. It's anybody who is not a government. So the funding cost has gone up for foreign sovereigns. The funding cost has also gone up for U.S. corporates. And so we have a tightening here of financial conditions, and the Fed hasn't talked about it much, mostly because they want to observe what's happening. These rule changes that Nick was alluding to are fully phased in the middle of October, but it means that there is no longer an advantage for getting your funding in USD. I allege that with the old structure of the money market funds, there was an implicit subsidy that was provided because money market funds were deemed to be cash equivalent by many, and that allowed foreign institutions and also U.S. risky borrowers to have access to cheaper funding. As that is going away, there might be no advantage anymore to get your funding in USD. And I'll just put that out there, and I said I'll write a separate newsletter about it, but it will have major implications, and in the context of the election, obviously, if we then issue certain uncertainties in trade and other things, it could greatly accelerate that foreign governments get more funding in their local currency and all kinds of things. So I'll just leave that at this one right now here. Let me give you here to talk about one more chart here before we talk specifically about election polls. What's happening, and usually we don't show a chart with that many lines on it because we don't want to be too complex. But this particular chart here shows the kind of the premium, the additional cost that different sectors in the U.S. pay when they borrow money. And clearly, the energy sector has had some challenges, has been out of favor with the drop in energy prices. But generally speaking, the funding cost is okay. This is just a little bit of an overview of where we are in the world. And we want to keep that in mind as well when it comes to the election, as different sectors might get hit differently by a new administration. Now, we're not going to give you specific stock tips here about which company is going to do best or worst, but I'd like to kind of just have you keep in mind that as far as the success of a particular sector is concerned, it does matter whether they're in favor or out of favor with a particular administration. And so now let's move on here and talk about the election specifically, and then what it means for some of the things we've talked about and specific markets. And obviously, I focus on the two main candidates. We obviously have two other candidates as well, but the decision is going to be amongst those two, according to most polls, or all the polls, that is. And clearly, especially Johnson can take some votes away. There is some disagreement whether he would, from the Libertarian Party, whether he would take votes away from both candidates equally or more from the Democrats, from Clinton. But the one thing I'd like to show here is to start out with where the current polling is. And notably, if you look at the red line, that is Trump, how Trump's odds have been rising. Remember, there was the Republican convention, and then he slipped, and when the Democratic convention was, Clinton was rising quite a bit. But then Clinton has had a pretty rough stride, and the polls came much closer together. Now, in recent days, we had these attacks or terrorist incidents in New York and in New Jersey, and there was a perception that previous perception of Trump might benefit. That has not yet materialized. That said, of course, we're still ahead of the first debate. At the same time, to just give you the latest headline, and CNN had a headline today, what has changed, and one of the things that changed is Iowa moved from battleground to lean Republican. So there are some battleground states here, or some important states here that are moving, and more important maybe than the overall polls is looking at it from a different point of view. This particular one is based from PredictWise. That's a website that surveys different betting sites, in particular also British betting sites, where people put actually money down of who is going to win, and those betting sites put their bets squarely on Clinton. Now, that said, I would like to show you one chart, a little flashback. This is the same website that was looking at the betting sites in the UK when it came to the Brexit decision. And the reason why that's very, very relevant is because obviously at the time the forecasts were wrong, and we were watching those very, very closely. There are a couple of reasons why they were wrong, and I think they're very much worthwhile to keep in mind. One of them, I don't know how relevant that one is, might have been weather. It turns out that in the areas where the Remain camp was, the weather was absolutely horrible. There was a big thunderstorm moving in through in the southeastern part of England in some areas that were firmly in support of Remain. That probably didn't make or break the vote, but one of the things that these betting sites have in common is that the folks in the UK in particular, well, the folks who have more money tend to be the ones from the cities, and they were betting bigger amounts. And so that tilted these prediction markets a little bit, because the folks who were more in favor of Brexit, well, they also love to gamble in the UK, but they happened to bet a little bit less money. And so those are the types of things that one might want to be aware of. And then just on the polls in general, the one thing that I think one has to be very careful about is it's referred to as the Bradley effect. And many of you might not know the name, but the concept I think is pretty clear. Bradley is was a 1982 race for governor in California, and Bradley was ahead in the polls, but he ultimately lost. And much of it is believed is that people just in the polls didn't want to say that they didn't want to vote for a black person. Bradley was black, and so they, when they were surveyed, they give the right answers to how they would vote. Similarly, I'm based in California. If you survey people at the Berkeley campus, a kind of a liberal bastion, so to speak, there are people who have said that no, they would not publicly admit that they favor Trump. Now, granted, California may not matter in this election. The kind of the states that do matter are other ones. But this just gives you an idea that you have to take these surveys with a little bit of a grain of salt. Nick, I'll have you explain this chart here.
Sure. So then ultimately, I mean, we can look at the general election nationwide polls and the prediction market indicators, but it will come down to the electoral vote count. And there are two very good websites that you can use to track these things. 270towin.com is where this chart is from, and it allows you to run through various scenarios and walk through hypothetical outcomes, and it will give you the tally. And as the website name suggests, it's the magic number is 270 electoral votes. That's what either side would need to win. The other website is 538.com. That's Nate Silver's noted data scientist website, and he's following the polls state by state very closely and putting probabilities on each individual state. And I just want to focus on a couple of key states here. So as of a couple days ago, this was kind of the base case from Nate Silver's 538. I believe Florida has just recently shifted into Trump's favor. And that really leaves what I think is going to be the key swing state, and others believe as well, which is going to be Pennsylvania. That would be the swing state that would tip a Trump victory over 270. As a side note, one of the other states that you can track to get an indication of where Pennsylvania will go is Ohio. Very similar demographics between those two states. They're right next to each other. I think Pennsylvania is more likely to be middle of the road, in other words, more likely to tip either way than Ohio, but whoever wins Pennsylvania is probably going to win Ohio as well. Well, especially if it's Trump. So let me leave it there for now, and then I'll come back to another version of this map that shows a potential Trump victory.
And so let's zoom in on Florida and Pennsylvania, how these states are currently leaning. We use here from Real Clear Politics, borrowing their chart here, and so on this particular one, they are dead even, and so Florida is obviously a must-win for Trump if he wanted to win, and it's often pointed out Clinton has multiple ways for victories, but Trump must win Florida. I want to zoom in here a little bit on Pennsylvania. In Pennsylvania, Clinton is ahead in the polls, and Trump is lagging. But one thing I'd like to show you is that this is a headline that's grabbed from the Financial Times from a couple of days ago. And it suggests that support for Trump is quote-unquote surging in Pennsylvania towns, and the article itself lists the specific towns, but that may matter a little bit less. But what the Financial Times is pointing out is that it might be difficult for the Democrats to mobilize some of the voters there that might favor Clinton, and Trump might have a better chance of voting the sort of folks that might tilt the vote in Pennsylvania. And so Pennsylvania is one of those states where one has to take the forecast with a grain of salt, that even if Clinton is leading in the polls, there is a chance that Trump is going to take get the state, the electoral college here, the votes here from that state. And the reason we say it always in this way is because the surprises to the markets might be greater if Trump gets elected. It's not that I'm trying to favor here one candidate over another one. And sorry, I think I jumped this one here. Nick, I'll hand it back to you here.
Yeah, so as I mentioned, we would come back to this chart, and here we've switched Florida and Pennsylvania to red states, and that would push Trump's electoral vote count, keeping all the others the same, to 279, which would be a potential road to victory. Now, it is true that Clinton has more combinations to victory than Trump does, but one thing that I guess I would add from my own view is that I think given the Brexit result, given potential Bradley effect at work, the probabilities are much closer to 50-50 in my view than are currently being expressed by the betting odds and the prediction markets. And we have three presidential debates coming up. Trump typically, I think, whereas Clinton does very well on substance and is noted for that, Trump as a reality TV star has a way of coming across kind of visually and vocally that Clinton lacks. And it, as an anecdote, in the 60s, I think it was JFK debating Richard Nixon. It was in the early days of televised debates, and those who listened to it on the radio felt firmly that Nixon had won the debate on substance, and those watching on television felt strongly that JFK had won the debate. So those sort of non-substantive elements of the debates, I think, have a big role to play.
Yeah, and these debates are more about sound bites than substance, and we know somebody who knows sound bites very, very well. So just as some food for thought here. So let's go a little bit more to the drier substance here of what these guys and gals, I suppose guy and gal, are going to do or might be doing. Now let's not forget that on the one hand, the president is quote unquote just the president. They are not Congress. They don't make the laws. Executive action, of course, can drive a lot. The bully pulpit, of course, can do a lot of things. And then they do appoint folks to the various agencies. And a lot has been said about the quote unquote administrative laws, how much power the administrative agencies have. And so they do influence what's happening. And kind of the three big buckets to think about, or that I think about here, is taxes, regulations, and trade. And when you talk to these depending on where you lean politically, you kind of always like what your party does, and you hate what the other party does. And much has been said about how Trump's economic plan might not be adding up on the taxes on all the spending versus the taxes he has. Well, I hate to break it to you, but Clinton's economic plan doesn't add up either. And so you can always talk a lot, but the one thing that none of these plans address are the long-term entitlement issues, which is something that's close to my heart. I happen to think that a country that cannot handle the long-term entitlements, cannot make the long-term deficit sustainable, is broke. And so unless we tackle that, we have big problems. And so from that point of view, I happen to think we have problems on both sides. Now, all that said, when it comes to economic growth, I do think that the U.S. is held back with an overly complex tax system, with an overly regulated tax system. And then, of course, on trade, what's very noteworthy is that currently the trend is to introduce more trade barriers. Be that just softly because it's not been that popular. So if a Clinton is suddenly against some of the trade deals, and by the way, it doesn't matter so much necessarily what Clinton is doing, because the rest of the world has the same sort of trend happening, that the European Union, for example, is backing away from the trade deal with the U.S. right now, and so the tide is certainly not in favor of trade. And of course, with the Trump presidency, we know that there is going to be some at least dust stirred up. I mean, it's possible that Trump talks to the Chinese for a month and then says, "Hey, we're best buddies, everything is great." But it is possible that he's going to start a trade war, and so I'll talk about what that means here for the markets here in a minute. There's a couple of here to look at this from a couple of other metrics. I have this image here, and what that's supposed to visualize is the bridge to nowhere. And the reason why I show that is that if you are a deal maker, and Mr. Trump presents himself as a deal maker, how do you get a deal done with Congress? Well, in my view, the way you get a deal done with Congress is that you promise the politicians whatever they like to have. Fiscal discipline is thrown out when you want to strike a deal. So I want to do my infrastructure spending project. I want to spend money on XYZ pet project. I want to spend it on healthcare, this or that, and there is another senator or a representative and says, "Yep, I'm going to help you build your pet project. I'm going to help you build your bridge to nowhere as long as I get your vote for my infrastructure project." And so that is the sort of thing that may well happen with Trump. I can see that happening quite easily because he politically doesn't feel strong about whose his allegiance is with, as long as he's going to get things done. With Clinton, that may also happen. She also was talking a lot about fiscal spending. Now, grant you, what happens if we get this ramp up in fiscal spending that it seems that both Democrats and Republicans seem to be advocating these days, and the one reason it may not happen is because if the other guy is in power, they might want to block it just for the sake of it. But Greenspan, I think, very prudently cautioned recently that if you ramp up fiscal spending and the unemployment rate is already low, well, the key thing that you're going to do is you're going to A, increase government debt, and B, you're going to induce wage inflation. You're going to induce inflation because you have a tight labor market already. And he said that ultimately the risk is that you're stuck with a bigger debt, but you have not done what ultimately is what you need to do. You haven't increased productivity. What you need to do if you want to get more economic growth, you need to increase productivity. If you want to do it with a limited labor force. And the question is, do we have policies in place or proposed even from either side that achieve that? And I'm afraid I don't see that on either side. And the one thing we might be getting is more inflation. Now, you can get GDP growth, obviously, with more government spending. The Canadians are trying that right now a little bit. And sure, in the short term, some numbers might look better. Everything else equal, that is. But will you really get more longer-term consumer spending? And ultimately, I believe that people will spend more and invest more if they're confident about the future. And for that, you need to have a clarity on policy. You need to have a sustainable budget. If you know that government deficits are not sustainable, then you can kind of think that the government is going to do to cheat you. They're going to tax you. They're going to inflate the debt away or do something else, and then you're less inclined to invest. And similarly, when regulations are overly complex, investors might be less inclined to invest. And so, obviously, depending on where you are politically, you might favor the policies of one party or the other one. What I don't see is that either candidate really has a breakthrough on clarifying things. Paul Ryan has a proposal that he wants to do if Republicans were to control both houses and Republican president, yes, we'll get entitlement reform. Well, we calculate the odds of kind of that triple whammy at a little over 10% maybe, so extremely unlikely, which means more likely is we're going to have the status quo with some tweaking, obviously with some very specific risks that are out there, but this logjam that we have in the economy, and we have Janet Yellen says she doesn't understand why. Well, it's very clear why. It's because we do not have policies that really foster investments to increase productivity. and there's a lot of blame to go around, and regulation is part of that. The tax code is another one. And by the way, somebody like Trump, he is saying that now let's talk about the impact on the market here. Let's start with a positive here. Trump says he would cut the repatriation tax of foreign earnings down to 10%. Well, that just shows that Mr. Trump doesn't know what he's talking about on some of these issues, because somebody who always comes up with radical proposals, why on earth does he want to penalize investments in the U.S. with 10%? I mean, somebody who just has plain blunt proposals should have gone straight to zero, which in my view is the only way that you can encourage people to make investment decisions that are prudent. Why on earth do we penalize people of putting money to work in the U.S.? And if that were to happen, sometimes we talk, oh, there's this tax holiday and so forth, and then some money gets repatriated. Well, those are all gimmicks. And yes, they might cause a short-term up move in the dollar, but if you really want to support the dollar, you allow people to invest capital without putting barriers in place. You remove a barrier, and you take that tax away. Now, that's politically not very popular right now, and it's unlikely to happen. And let's talk about kind of these international moves. And the big elephant that's out there, the so-called wall to Mexico. If we introduce barriers to trade, and we are currently in an environment where barriers to trade are rising, then it's my assessment that currencies of countries that have a current account deficit are suffering. And the most recent and strongest example is the UK with its Brexit vote. The sterling plunged when the UK voted to leave the European Union. That is a barrier to trade. Maybe they'll find some good solution down the road, but for the time being, that's a barrier to trade. That is bad for the sterling, and was bad for the sterling, in my view, because the UK has a current account deficit. So similarly, if we introduce a trade war, if we introduce barriers to trade, that, in my view, should be very, very negative on the dollar. Now, that said, not necessarily to all currencies, and I'll show you a slide here in a moment that there are some exceptions. But when you talk about, especially versus the country with a current account surplus, and something like the Eurozone, so the Euro would be a big quote-unquote beneficiary if you were to introduce a trade war in the U.S. Now, we touched on the repatriation of income. Let me just touch here on share buybacks briefly. We've driven share buybacks to extremes. If you believe that interest rates might be going up, share buybacks are not going to be as attractive anymore. Corporate earnings have been on the decline. That gives corporations less power to do share buybacks. Equities in general might be at risk if indeed interest rates were to move up. Now, as far as the election is concerned, whether any of that is going to influence it, it remains to be seen. M&A activity, that's very much dependent on the sort of policies that are put in place, whether companies believe they have to be stronger. On the bond side, I showed earlier the chart on the stress or the tension in the LIBOR markets. Some people thought that this is just temporary and the LIBOR market is pre-pricing in a rate hike in the U.S. I think that's the wrong way to look at it. We have a major shift happening where funding gets more expensive. Now, the question is, where's the cost of the government going to go? And many people believe that, oh yeah, the Fed is going to keep rates low. And by the way, in Japan, they now target the long end of the yield curve. Well, and Mr. Gross, as much as I respect him, he said on Bloomberg that when the Federal Reserve targeted long-term rates from, I believe it was from 1942 to 1951, that worked without a hitch. It didn't. When the Korean War broke out, the market was dumping treasuries, and the Fed struggled to remain the peg. Ultimately, central banks are just zipping from a straw in the ocean. And so if indeed the market believes that we are moving increasingly to an era of fiscal irresponsibility, and both our candidates want to ramp up fiscal spending, then I would not bet that central banks can retain control of the bond market. Let's also keep in mind that we're currently extremely lucky because the kind of just where we are based on various trends, the current deficits are lower. They're bound to to go up quite strongly. Now, clearly, if they have a central bank that pushes rates down and is succeeding at that, the overall cost of serving the debt might go down. But there has to be a valve, and in my view, in my book, that valve tends to be the currency. Now, talking about the currency, here we have the trade-weighted dollar index, and we continue to be 2 standard deviations above the long-term average when it comes to the dollar index. And I just like to rattle people who still believe that because we're hiking rates in the U.S. and are lowering rates elsewhere, that the dollar has to be the winner in this. Year to date, the dollar has declined substantially. It is in anticipation of the first rate hike that the dollar tends to rise. I've said this for a long time. When rates actually start going up, history is not clear that the dollar will hike. It often does not. And this is one of the reasons we've gone already to extremes. And by the way, to just tie that to that LIBOR chart earlier, one of the things that happens when people stop funding themselves in dollars, if you issue debt in dollars, that's a short on the dollar. If you unwind those, that's like a short squeeze because you have to buy back the dollar. I would allege that we've already had in recent years a lot of that take place, and we already see a shift of people using other funding sources. And so we may not be getting here a boost to the dollar from the bond market in that sense, and going forward as this LIBOR thing unfolds. But more importantly, we have a Fed that's firmly behind the curve, in my view. Yellen disagrees with that, but I think so. Martin Feldstein of Harvard said the other day that seems to be the plan of the Fed. And then, by the way, to tie it into what's happening at the ECB, the European Central Bank said recently, Draghi said that they see less of fragmentation in the market. Fragmentation is where the weaker players, for example, in the Eurozone, pay a substantially higher rate to finance themselves. Well, if the fragmentation is done and over with, we don't need to print as much money. So we are much closer to the end of the easing cycle in Europe than people are anticipating, and we're much closer to the top of the hiking cycle in the US. And so in my view, investors might want to consider to start selling the dollar here in earnest versus basket of currencies or versus gold or versus anything really. And now I told you that not everything obviously is going to benefit in the currency space if we have a trade war. The one thing that's been mentioned in the news quite a bit is that the Mexican peso might suffer if Trump gets elected. And here's a chart here. This is, mind you, this is just 3 months here, and the correlations can be deceiving. Sometimes one wants to overinterpret something into charts. We've done some little broader analysis, and it's a little difficult to do with the sort of data that's available. But the short of it is that the Mexican peso is nice to talk about, but other currencies like the Polish zloty, for example, and certain other items might also be correlated to a potential Trump victory. And so, yes, there's a fear that the Mexican peso might suffer if Trump wins, and some of that might just be that perception becomes reality, that as more people are taking on trades of that sort, that this correlation is going to increase. So it's just something to keep in mind here, that when I say that introducing trade barriers weakens the dollar, that's not necessarily versus all currencies. The Mexican peso, by the way, is the currency that's, in my view, one of the highest correlated currencies to the S&P 500. And so the other thing that means is that the S&P 500 might just suffer when Trump gets elected. And so in that sense, the question is, do we have a quote-unquote election-proof portfolio that we have available? And we pulled out an old cartoon to illustrate that point. To put this into context here, where are we year to date? Year to date, gold is the best performing asset class here on this chart. Oil is one of the best performers. People always think oil is down so much. Well, year to date it is up. And the dollar is actually the weakest on this chart. If we were to break down the dollar, it turns out the yen is actually the strongest player. Usually you have gold and the yen be very strong in the 2008 type of scenario, in a crisis. But if you take the S&P 500, that's also up year to date. So many things are up year to date, and it's at the expense of the dollar. The The danger when you have so many things go up is that a lot of things can go down, of course, and that's what we like to caution as when people do look at their portfolios. Now, here I show you a kind of a big wealth here of lines. And by the way, if you'd like to have a copy of these charts, please, you can put that in the Q&A box here, and we'll be glad to follow up here with a copy of the presentation. If you want to study these in a little bit more detail, what this chart shows is the 10-year yields in the G10, in the major countries. And one of the things that has happened is we've had an uptick at kind of the right-hand side, and a lot of that is because central banks have been trying to talk up the long end of the yield curve. Japan most recently has been trying to push that higher. The question is that a good thing or a bad thing? As you have these yields go up, there's a risk that we have a headwind to the stock market, and specifically, I want to pass it here to Nick to explain this chart here briefly. Go ahead.
Thanks, Axel. Well, this kind of ties in a little bit with what I was saying earlier on the VIX chart at the beginning. The blue line is the average, just an equally weighted average of the G10. Those are the currencies we just saw on the last page. If you think about blending all those lines together, taking the average, that's the blue line that we see here. Very clear downtrend over the past 15 years or so. And it's relevant because most recently because you see the red line, that's the price to earnings ratio, the valuation multiple for the S&P 500. And something interesting happened, really started to happen in late 2014 actually. Earnings for the S&P, if you just look at the S&P 500 company earnings in the aggregate, were going up really nicely from the beginning, Q1 of 2010 to Q4 of 2014, and they've been declining since then. And typically, if you have declining earnings, you're going to have a falling stock market, assuming that you have the same valuation. But as these earnings have been declining, the valuation multiple has been expanding, and that's allowed this market to essentially levitate at its current level. I mean, we're at new all-time highs recently, but we've been in a fairly narrow range since late 2014 on the S&P 500. And the reason is that if you think about fundamental valuation, discounted cash flow analysis, for example, that is based on discounting these cash flows at a risk-free rate. And typically you would think about using potentially the 10-year U.S. Treasury yield as that discount factor. The lower those yields are, the lower the discount factor that you use, the higher the present value, the higher the valuation you get out of that fundamental analysis. And so it's very difficult to have a view on what's going to happen to the equity market without thinking about these dynamics of this massive and ongoing, at least up to this point, bull market in bonds that has just continued to bring yields down. Axel? And
I'd like to just throw in, there's a very good interview with Alan Greenspan. I'm praising him here for the second time today. I'm not a Greenspan fan, so don't take me wrong on that, but he gave a very good interview on Bloomberg, and you can look it up there, where he pretty much said that this rise in bond prices is just not sustainable. And he did say, of course, right away as well, that the timing that is not easy. And when it comes to timing, let me maybe here take it to this highly sophisticated illustration of how a portfolio might want to look like. We have been preaching for some time that when you have these asset prices that are elevated, when you are in a complacent environment, when you are in an environment where stock prices are dependent on multiple expansion, there is just a lot that can go wrong. And so what investors want to do, and we focused on some of the things of Trump and Clinton, that and zooming in here on the risk to trade. But and the reason why I didn't talk more about Clinton, by the way, is because she's more expected to have a continuation of the status quo. But that also means we're going to continue to have the sort of barriers in place to investments that we already have, with a little bit different flavor maybe, and that's not good for long-term growth either. And so all of that has to be then seen in the context of expensive asset prices. And so we think investors want to have something that has a low correlation. Now, in the middle here, we show gold. Gold historically has had a very low correlation, exactly zero, to equities. Now, that said, that doesn't mean the correlation is always zero. In recent weeks, it's been very closely tied to the to the movements in the bond markets. And so when you have an unraveling, we continue to believe that gold is going to do quite well in that sort of environment, but it doesn't mean it's going to do well necessarily in the first wave of that or in every wave that's out there. And then, of course, we like currencies because you can design a portfolio, like a short portfolio in currencies. And also, as I pointed out, I happen to think that we reached the peak in the dollar. I think we reached that towards the end of last year versus the major currencies. When you have a lot of stress in the markets, emerging market currencies tend to be more vulnerable. But as far as the major currencies are concerned, I think that the dollar has seen its peak, and so diversifying outside of the dollar might also make some sense. And so with that, this is not a fund presentation today. So this is just a quick look here on our the funds that we do have. As a reminder, we do have our quarterly fund revenue in October, where we discuss the funds in detail. And so with that, I pass it back to David to manage the Q&A.
Great, thanks, Axel. Please now take a few minutes to read the following disclosure as we move to the Q&A portion of the call. Again, I would like to remind everyone that you can ask a question by typing it into your text box. So our first question comes from Jim Richardson, and he asks, James Rickards is suggesting that there is a major currency event about to happen on September 30th of this year. Would you have any insight in these regards? Axel?
Sure. Well, Jim Rickards is somebody who loves to tie politics to the markets and believes that the big players in the world can control the markets. I come more from the point of view that the markets are in charge, but policymakers provide major distortions. And specifically, he's referring to the inclusion of the renminbi in the SDR as officially be added as a reserve currency. Well, I happen to disagree with Jim on the specifics that he's talking about, because the major countries are not going to change the reserve management. When you get a loan from the IMF, some of it may likely be denominated in RMB and renminbi going forward. It's just some very, very small portion of reserves that are actually managed in accordance with the IMF guideline of how reserve currency should look. That said, yes, the renminbi is gaining in importance. The real change here, if I had to pick a date, I would change it to the change in the money market funds. Now, even that though, those changes are not new. They have been phased in, and the market has already been getting ready for those changes. So I do think that the changes in the LIBOR market as a result of what's happening in the money market fund regulation in the U.S. are far more important. Now, the net result is same, that the dollar is suffering as a reserve currency. So maybe we're just here talking little details here, but I'll expand on that discussion in an upcoming newsletter. Hope to get that out to you in the coming weeks to put some clarity on what exactly that means for the markets. Back to you, David.
Okay, our next question comes from Ankit Pandey, and he asks, in case Mr. Trump wins, he is likely to slash tax rates, individual and corporations, which will adversely affect America's ability to repay its debt. Is there any way then that interest rates would not soar and the U.S. dollar would not depreciate significantly? Axel?
Well, I hate to break it to everybody, but the president doesn't set tax policy, and I don't say that in disrespect to the person asking the question, and neither in disrespect to either of the candidates. But obviously they influence the agenda, but it's the majority leader and the speaker of the House and the Senate that really drive that agenda. And so you really have to think about, is there room for substantial tax reform? And unless you have everybody kind of pull on the same string, that's kind of difficult. Now, that said, to answer the broader question, the policies we have in place, and including tax cuts, are not going to fix our long-term entitlement issues. We do have this trend that on the Republican side, they don't seem to be less concerned about entitlements than previously. Paul Ryan is a big exception to that, and obviously he's influential. Now, the other part of that question is, will we see a soaring of of interest rates and inflation as a result of that. And as we've seen, I mean, we've had, in my view, irresponsible fiscal policy for years, and we haven't seen a blow up. The thing is, there's always a risk. And yes, I do think at some point interest rates will be substantially higher. Maybe central banks will fight it, and then we'll have other side effects like inflation high and interest rates low, or the dollar suffering substantially, or something like that. What the trigger and the catalyst is, I can tell you with hindsight with 100% certainty. But ahead of time, that's going to be very, very difficult, because it's very difficult to say what the trigger is going to be. We've seen various crises, and the markets just don't seem to care. We have a coup in Turkey. The markets are not rattled. And so it's likely going to be something very, very different. I can imagine that investors being fed up with cronyism in Silicon Valley when the CEOs start merging companies and giving loans to one another, that sort of thing is going to rattle the markets. That's something they're not thinking about. Or more likely, that ties into the LIBOR story that I was telling earlier. There's another thing that I haven't talked about, and is that in addition to the funding costs going higher, the bank regulations we've introduced in recent years make it very difficult for banks to gear up their balance sheets. And as a result, there are various arbitrage opportunities in the markets that are not taken advantage of, and the one that's closest to my heart is what's called covered interest rate parities. That traditionally it should be equivalent of buying a foreign currency in a bond versus a forward currency contract and staying domestically buying a treasury security. Every textbook on currencies explains that that's how it's supposed to work. Well, it ain't so anymore. There are huge gaps in that, and the reason why there are these holes is because banks have too high a funding cost, and regulations don't allow them to take advantage of that. Now, where's the relationship here? The relationship here is that it shows that there's a lack of liquidity in some crucial components of the markets. And so if we do have disruptive events, we can have a cascading effect because the major institutions cannot jump in and fix those sort of things. And so that's really, and that can happen to anything. That can cause ripple effects on the equity side, that can have ripple effects on the bonds. And it's that sort of thing that's, in my view, going to topple the markets. And then, yes, we will blame in hindsight that our spending was irresponsible, and then we blame the president, whoever it might be, who's in power then. Or we'll blame the Fed. David?
Okay, and our last question comes from Sharom Rashani. And the question is, with respect to currencies, what is the downside risk, in parentheses, I assume Donald being elected, close parentheses, and how much would major currencies move if this occurs? Axel?
Yeah, I mean, first of all, just like everywhere else in the airways, we talk about Trump much more than Clinton. That just shows you how difficult it is for Clinton to get airtime because he's just much more radical, and so people tend to talk about him. And I think I addressed most of that. So I do think that the dollar is at risk when it happens. That said, versus the major currencies more so, then versus emerging market currencies, and I group, as I showed here, the Mexican peso in the emerging market bucket, because there will be some specific damage caused to trade relationship with Mexico. But other than that, if you need to have borrowing from abroad to finance your deficits, and you put barriers in place to trade with those countries, they're going to be less inclined to invest in your country to help finance your debt. That means the funding costs in the U.S. is also going to go up, and that then goes back to kind of this idea that we have the printing press and we can spend as much money as we want to. That might just not be prudent. Because at some point, yes, the bond market is going to put some barrier into place. And to close it up, to wrap it up here, if you're an investor, do stress test your portfolio. And the best way to do that is that when everything goes up in your portfolio during the good times, you might have a problem. And look back at how your portfolio behaved in January. And were you happy how it performed? And if not, the time to adjust that is now. David?
Great, thank you, Axel. And that concludes the Q&A portion of the call. So if we were not able to get to your question today, we will get back to you via email. So should you have any additional questions or comments, please use the Contact Us section of the website at www.merkinvestments.com. And always feel free to reach out to James at any time, and he'll be more than happy to help you out with any questions. As a last reminder, we do have another quarterly webinar coming up next month on October 18th, so stay tuned for that. And this concludes our call. Thank you, and have a great day.